Hey, hello everybody. Hi, my name is Darius Anucauskas and I'm the global market analyst here at Markets.com. So look, I wanted to quickly share with you an idea on a US CBIs, which are coming out tomorrow. So I'm recording this one on Tuesday. So yes, we have a big day tomorrow. So I thought I'll record this one way in advance. Look, before we jump in and actually into all this action, let me have a quick read through our risk disclaimers. So yes, the content we produce does not constitute investment advice or investment recommendations and should not be considered as such. This material should not be taken as an invitation to acquire any financial instrument or product. Look, I'll give you a few seconds to read the rest. I'm not going to disappear anywhere, but yeah, we do have quite an eventful day coming up tomorrow. Today's Tuesday, so today we have the so at the time I'm recording this, we still have the Jerome Powell's testimony in front of Congress, so which will be continued tomorrow. But look, let's have a look at the economic calendar very quickly. So yes, what I'm seeing here is that the headline year-on-year inflation number is expected to come out at 2.9, but the core inflation rate, so the year-on-year one, is expected to decline a little bit. Now, okay, the way we can interpret this. So basically, as we know, the core one excludes energy and food prices. So in that one's showing that there is a potential decline, which is great in a way for the Fed, because the Fed has its inflation target set around 2%. However, we've seen that, let's say, even with the headline one, I mean, the lowest we were back in October when the data came out, and that was the data for September. The inflation in September was at 2.4%. So basically, kind of got the closest to the 2% target, but then started picking up again. Well, look, we were in the holiday season, and then now we're having the new elected government deciding on its policies and on the tariffs, and basically this is giving a little bit of a shakeup in the market. So in a way, I think that inflation will continue rising unless somehow we somehow get some sort of stimulus or something that supports. But even then, it will be just a temporary fix, which could kind of just play in, into higher inflation later on. So I think that the Fed understands all that, and that's why they're kind of taking this cautious approach and not really doing much. And I think that they're going to hold off from cutting rates. So look, I'm looking at the end of this year, and by the end of this year, we're currently expecting only one cut. In general, I think that we might even not have a cut. But again, that's my opinion, because again, of course, it depends on the data, how it comes out. Maybe inflation suddenly somehow drops magically, but I kind of doubt, with all the spending and all the way the new government is kind of engaging in its policies, and it kind of leads to the point where we could see a slight increase in inflation. So if that's the case, of course, the Fed then is in a bit of a pickle, because again, you need to, if your inflation is rising, then you need to start considering hiking rates. But I think that at this point, the Fed doesn't want to do that. Look, a lot of times in my previous webinars, I said that, especially last year, I said, look, inflation will pick up again, and I think that the whole point that the Fed was on this, really rapid cutting mode in 2024 was purely because of that, because they were hoping, they were not hoping, but they were expecting to see inflation on the higher side later on. Maybe at the end of 2025, maybe going into 2026. But again, still inflation probably could pick up. So this is the point where, you're actually at this stage where you're thinking, it's better to hike rates from the lower level, right, rather than from the higher level. So that explains the rapid cuts. So some, of course, critics say that, hey, maybe the Fed was doing way too fast of a cut, and maybe that's what's going to lead to higher inflation. yes and no. So you can, there's always two sides of the stick here, and two sides of this story. So somebody believes that, somebody believes another thing. But either way, what we have right now, we go from that. So what we're seeing right now, we're seeing inflation around 3%, maybe a little bit below that. If it starts picking up above, let's say the headline jumps above 3%. I mean, this could, of course, help strengthen the U.S. dollar. I'm currently looking at oil here, but if I jump into the U.S. dollar very quickly, yes, it might strengthen that a little bit, but at this point, what I'm looking at here and what I'm seeing, I see that the US dollar is stuck a little bit, which is explainable. I think that the US dollar is also waiting to see what's going to happen with the CPIs here. But in a way, we're stuck in this little range-ish kind of thing, kind of moment. But let's put it this way. For now, if you're looking for some higher levels on this one, on the US dollar, well, for me personally, I mean, I would prefer to wait for a push above the 110 zone, the psychological 110 zone, which then could open the door to some higher levels here, which basically could open the door towards this area, which is the highest point of 2022, and that's around 114.72 mark, roughly 115. But again, I have to say this way, that don't try to rush into things. First, let's see what's going to happen. Are we going to get a higher number actually, or are we going to stick to the forecast and come out the same at 2.9? So in general, 2.9 and 3.1 here on the core year on year is still on the higher side. It's still above Fed's target, which is at, like I said, 2%. So any kind of further increase, that could, like I said, that could kind of in a way maybe start spooking the market, the stock market. And what I mean is that, look, the US 30 here, so which is the Dow Jones Industrial Average, is kind of near its all-time high right now. It's kind of knocking on the door. We're stuck. It seems like it wants to go higher. If inflation comes out on the lower side, and yes, great, we could see maybe a further move north. However, if it starts like picking up the pace, then this is where risk off environment could start showing up even more. And this is where people could start, maybe, I don't want to say panicking, but in general, it wouldn't look as positive as everybody would love to see it, because we have our tariff wars, we have inflation starting to pick up. So then there's a threat that the Fed might actually abandon any cuts at all, which, like I said, that's my point, which I mentioned in the beginning of this video, and that's what I'm referring to. So in order, like I said, in order to kind of understand and what could potentially happen, certainly let's not try to improvise too much. Let's wait for the number to come out, and then we can, like I said, and then we can try to to see what we can do with all these instruments here. So with the stock market, like I said, a higher inflation number could kind of spill into something maybe not too positive in the medium term. In the short run, this is actually could be a little positive for the stock market, because in a way, let's not forget that slight inflation is an indication of economic progress and growth. So let's say the headline inflation comes out at 3%, and we suddenly start seeing the stock market rallying. So this is exactly what I'm referring to. So this is where the stock market could actually, stock market participants could actually see this as a somewhat of a positive and kind of jump on the bandwagon. However, later on, once the this whole excitement kind of fades away and we start seeing some more issues, let's say with tariff wars and with some retaliation from other countries on whose products, on which products it's the tariffs are placed. So then, of course, this could spill into a bit of negativity. So long story short, if we do get a slight increase in inflation, for example, we get, let's say, a 3% coming out here, this could, like I said, initially maybe could be a little bit of a spike higher or something on the stock market and on indices. But then I think maybe reality could kick in. I think that this percentage here could eventually maybe even drop. Maybe we could actually go to towards this idea here where the rate could stay the same for the remaining of this year. And this is, like I said, this is where everybody could say, oh, you know what, wait, that's not all that rosy as we like, and then everything could drift back down. The US dollar certainly could push higher on the higher number. However, if let's say the number comes out at 2.9 or even maybe 2.8, the dollar index here could actually drift a little bit lower. This leads me to the point where all these pairs like AUD USD, which are kind of waiting for a moment, or should I say these bulls here are waiting for a moment to enter. This is where it could play out for them perfectly. So we could see those little pops here. AUD USD, for example, if it could travel above the 50-day EMA here shown as the green line, then I will aim for the 100 and the 200-day EMA. Jumping into Euro USD here. Well, the Euro USD is slightly a different kind of animal, because again, the euro is a little bit on the weaker side. So that's what I'm saying. So this one, it might pop a little bit higher, but I think that we need some sort of like better news from Europe in order to support this this upside here on the Euro USD. However, the GBP USD here could actually enjoy the positivity and could push higher. Again, let's wait and see, of course. Let's see what's going to happen here. Talking about USD JPY. At the moment, this is, like I said, this is more of a problem of not the US dollar, but actually how the Japanese yen is performing. At the moment, there is a lot of positivity surrounding the Japanese yen, because that one, like the Bank of Japan, is kind of considering maybe to go for another hike. And that may support the Japanese yen even more, especially even if the stock market starts drifting to the downside. This is where people will start jumping into the Japanese yen. And this is where we could see a bit of weakness here in this USD JPY pair. But again, this is all theory. As I said, let's wait for the numbers to come out. Like I said, it could be quite interesting. I think that this is where the market will react. We'll see a lot of volatility here. So if you are trading something dollar or US related, not only dollar but US related, so be careful. Try not to try to play the game of prediction. Just rather wait till the numbers come out, the headline and the core come out, see the reaction, and then do something about it if you feel comfortable with it. If you don't feel comfortable, if it doesn't tick all your boxes, don't approach it. Honestly, leave it. You'll find a better opportunity later on. So, ladies and gentlemen, I hope this was useful. Thank you very much for watching and listening. My name is Darius Anucauskas, and I'm a global market analyst here at Markets.com. So, hey, give me a thumbs up, subscribe, like, and do all that stuff, please. Leave a comment if you wish. I would really appreciate those. We can have a discussion about this. And yeah, I'll see you later. Thank you very much, and bye-bye.